Welcome to This Explainer. Today, we're diving beneath the chaotic, day-to-day surface of the stock market to discover the true, underlying engine of wealth creation. We're looking at why the stock market is, ultimately, the slave of earnings. So you gotta ask yourself, what actually drives the stock market? If you're feeling totally overwhelmed by the 24/7 news cycle, the random panics, the sudden surges, the endless talking heads, it is absolutely crucial to step back. Are you just watching the short-term waves crashing on the surface, or are you paying attention to the deep, powerful currents moving beneath? Let's break down two completely different forces at play here. In the short run, we have the noise. It's a highly emotional market reacting violently to fear, greed, and macroeconomic liquidity shifts. But over time, all that noise fades and the long-term reality takes over. Because eventually, stock prices have no choice but to track the direction of net profits. Now, in the short run, it is incredibly easy to get sucked right into the illusion of surface-level hype. We've all seen it, right? Whether it was the dot-com boom of the late 90s or the recent meme stock crazes taking over your feed, people fall for these euphoric narratives, convincing themselves that, hey, this time is different and the old rules of valuation just don't apply anymore. It feels amazing while it's happening, but it's an illusion. And honestly, that leads us right into a massive trap. A fantastic story can pump a stock's price to the moon temporarily, but here is the harsh truth. Euphoric narratives have a strict expiration date. Hype always expires. You simply cannot run a business on enthusiasm alone. Eventually, the market wants to see the receipts. Which brings us to what we call the law of gravity in investing. Because just like physics, the market has rules you literally cannot break forever. Without actual tangible bottom line growth, even the biggest, most aggressive market rallies will inevitably collapse. Eventually, reality exerts its gravitational pull, bringing those inflated stock prices crashing right back down to earth. And here's exactly how this timeline unfolds. Phase 1 is over in days. A crazy, euphoric narrative catches fire on social media or financial news. Phase 2 drags on for months as you see this massive, temporary pump in the stock price as the crowd rushes in. But Phase 3? That spans years. It's a complete slow-motion collapse if there are no actual earnings backing it up. Time is the market's ultimate truth teller. So you might be wondering, looking at that inevitable collapse, can a company just market its way out of trouble? Can clever PRs save a fundamentally bad business? Like, if you have a phenomenal communications team spinning every piece of bad news, can you keep the stock price elevated forever, even if the business is bleeding cash? Well, the reality is there's absolutely no hiding place. None. No amount of clever PR, no matter how brilliant or well-funded, can permanently sustain a loss-making business. You can spin the story, you can rebrand, you can announce bold new initiatives, but if the company is consistently losing money, the math will always catch up with the marketing. Okay, so if hype and PR are out, what actually works? We arrive at the core engine of it all. EPS rules all. It's not about the flash, it is strictly about the cash. What's genuinely fascinating about this is the sheer mathematical certainty of it. Consistent growth in earnings per share is the absolute, undisputed driver of long-term wealth creation. When a company's profits grow on a per-share basis year after year, the stock price has no choice but to follow it upward over the long haul. It's like the purest expression of financial gravity actually working in your favor. So, how should we define real value? Well, price is merely what you pay, right? It's just the current sticker on the stock, which is heavily influenced by all that short-term noise we talked about earlier. But true value, that lies in those underlying corporate earnings. That is what secures your compounding wealth over time. It's what you're actually buying when you purchase a share. So, how do we actually translate this fundamental truth into our daily habits when we're observing the markets? How do we use this to keep from getting burned? We have to focus on substance. Because this is exactly how the pros operate. They don't get distracted by the shiny objects. They dig right into the foundation. Savvy investors completely ignore daily ticker fluctuations. They honestly don't sweat whether a stock is up 2% today or down 3% tomorrow. Instead, they dissect the quarterly operational health of the business. We're talking the balance sheets, the income statements, the actual free cash flow. They keep their focus entirely on substance, just completely shutting out the noise of the crowd. And this leads us to a really critical distinction. Investing requires earnings backing. You are buying a piece of a living, profitable, growing business. Gambling, on the other hand, is just speculating on pure price action. Buying a stock just because the line on the chart went up yesterday, without any underlying earnings, is a literal roll of the dice. And casinos aren't exactly known for losing money to gamblers. So we've stripped away the short-term noise, we've exposed the trap of hype, and we've established the unshakable law of gravity. And all of this leads us to the ultimate bottom line. This is the one inescapable conclusion about the market, the single truth that dictates who builds wealth and who loses it over a lifetime. The stock market is a slave to earnings. Full stop. The market might act totally crazy in the short term, running off on these wild tangents fueled by emotion and liquidity. But earnings? Earnings are the master holding the leash. If you focus your attention and your capital on companies that are actually generating and growing net profits, the returns will inevitably follow you. You follow the profits, you secure the compounding. As we wrap up this explainer, I want to leave you with a crucial question to evaluate your own holdings. Honestly, ask yourself right now, is your portfolio built on temporary hype, or is it built on solid, bottom-line growth? Are you riding euphoric narratives that are destined to expire, or are you anchored to the mathematical certainty of corporate earnings? Think critically about what you actually own. Thanks so much for joining me. Keep focusing on substance, and I'll catch you in the next one.